Hey everyone, welcome back to Trek for Wealth, the podcast where we talk about money the way real people actually talk about money. I'm Avery.
And I'm Grant. And Avery, I want to start today with something very simple. When did you last fill up your gas tank?
Actually, just yesterday, and I winced because it was a lot more than I expected.
How much?
$3.89 a gallon. I nearly choked.
So you're right at the national average, because as of yesterday, March 18th, AAA reported the national average for a gallon of regular gasoline hit $3.84, the highest level since September 2023.
And for context, just 3 weeks ago, before the US and Israel launched strikes on Iran on February 28th, the national average was $2.98.
That is a nearly 90-cent increase in 3 weeks. That is one of the fastest gasoline price spikes in American history, larger than anything we saw after Hurricane Katrina in 2005, larger than the Gulf War spike in 1990.
And oil itself, Brent crude, has gone from $67 a barrel to touching nearly $120, a 50% surge in 3 weeks.
And here's what I want our listeners to understand today. This is not the first time this has happened, not even close. And every single time oil has spiked like this in American history, there have been profound consequences for the economy, for jobs, for the cost of everything you buy, and for wealth.
The history of oil shocks is really the history of American recessions.
Let's get into it.
Okay, Grant, let's build the historical case, because I think people know vaguely that gas prices and recessions are connected, but they don't necessarily understand why. Start there.
So, the connection runs deeper than most people realize. The St. Louis Federal Reserve studied this. They looked at every major recession since World War II, and what they found was striking. Nearly all post-World War II recessions in the United States were preceded by or accompanied by a sharp increase in energy prices. Not some, nearly all.
So, oil isn't just a symptom of economic trouble, it's actually a cause.
It's both. But here's the mechanism. Oil is embedded in everything. Every piece of food you buy traveled on a truck that runs on diesel. Every flight you take burns jet fuel. Every product in a store arrived via supply chains that depend on energy. So when oil prices spike suddenly, the cost of producing and delivering everything goes up. Companies either absorb that cost, which crushes their profits, or they pass it on to consumers, which crushes consumer spending, which slows the economy.
And there's a second mechanism, too. When people spend more at the gas pump, they have less money for everything else. It's a stealth tax. The money doesn't go to the government, it doesn't circulate in the domestic economy, it goes to oil producers.
Exactly. Time magazine just published a calculation this week. Since the war in Iran started, Americans are paying more than $300 million in additional fuel costs every single day. $300 million a day that was previously going to restaurants, to movies, to savings, to retail spending. Now going straight to the energy market.
$300 million a day. That is an astonishing number.
And it compounds, because higher jet fuel costs mean higher airfares. Higher diesel costs mean higher grocery prices as transportation costs flow through. Higher fertilizer costs, which are oil-derived, mean higher food prices months from now. The pain at the pump is just the opening act.
Okay, history. Walk me through the big ones.
So let's go in order. October 1973, the Yom Kippur War. Arab members of OPEC declare an oil embargo against the United States for supporting Israel. The price of oil quadruples literally overnight, from $3 a barrel to $12.
We covered this in episode 2. Gas lines stretching around the block, the lights going out in Times Square, Nixon imposing rationing.
And the economic consequences were severe. The 1973 to 1975 recession was one of the deepest since the Great Depression. Simultaneous inflation and economic slowdown, what economists call stagflation. The Fed chairman at the time described it as the most inopportune timing for an oil shock because inflation was already running above 10% when the embargo hit. Sound familiar?
It sounds exactly like right now.
Then, 1979, the Iranian Revolution. The Shah of Iran is overthrown. Oil production collapses. The global oil supply falls by just 4%, but the price of crude oil doubles from $15 a barrel to nearly $40 in 12 months.
Because in commodity markets, even a small supply disruption creates outsized price panic.
Exactly. And the 1979 crisis triggered two recessions back to back, the 1980 recession and the 1981 to 82 recession, which we covered in episode 3 as Volcker's era. By 1980, lines at gas stations in states like California had odd-even rationing. Only odd-numbered license plates could buy gas on odd days. People planned their entire week around when they could fill up.
Gasoline rationing in America in our lifetime. People's parents remember this.
Then, 1990, Iraq invades Kuwait. Oil prices spike again. The 1990 to 91 recession follows. Then, 2007-2008, oil goes from $60 a barrel to $147, its highest level ever at that point, contributing to a recession that nearly collapsed the global financial system.
So we have 1973, 1979, 1980, 1990, 2008. Every single one connected to an oil shock.
Every single one. The St. Louis Fed's average real energy price increase before each of those four major recessions from 1973 to 1991? 17.5%. That's the historical threshold. We've already surpassed 50% in 3 weeks.
50% in 3 weeks versus 17.5% before previous recessions.
Which is why the Aramco CEO said this week that the current disruption is by far the biggest crisis the region's oil and gas industry has ever faced. Not one of the biggest, the biggest.
Okay, I want to give our listeners some balance here, because I've been reading that some economists are actually not as alarmed as the oil experts. What's the case for calm?
And it's a fair and important counterpoint. Nobel Prize-winning economist Paul Krugman wrote about this week. He said the U.S. economy and other major economies have changed greatly since the 1970s. We're much less dependent on oil than we were 50 years ago. In 1973, oil represented a far larger share of the U.S. economy. Today, services, which are much less oil-intensive, dominate. Technology, healthcare, finance. These sectors don't get hit as hard by oil spikes.
The economy is less oil-intensive than it used to be.
Significantly less. And the U.S. is now a net oil exporter, something that would have seemed impossible in 1973. We produce more oil than we import. So while we're not immune to global price spikes, we're more cushioned than we were.
And the Fed has more tools and more credibility today than it did in 1979. Jerome Powell literally said this week, quote, "I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in." He's explicitly pushing back on the 1970s comparison.
Though the Fed also just held rates steady for the second meeting in a row. They didn't cut because inflation is still running above target at 2.8% on core PCE. And oil is now threatening to push it higher. And they lost 92,000 jobs in February, so the Fed is simultaneously fighting inflation and watching the job market weaken, which Morningstar economists described as, quote, the FOMC's worst nightmare.
So the honest answer is somewhere between Krugman's relative calm and the oil experts' hair-on-fire alarm.
The honest answer is that we genuinely don't know yet, because as Powell said literally 3 times in his press conference yesterday, nobody knows. The size and duration of the Strait of Hormuz disruption determines everything. If it reopens in weeks, manageable. If it drags on for months, the historical precedents are deeply concerning.
And since we can't know, we go back to episode 7, preparing without predicting.
Preparing without predicting, always.
3 wealth moves. What do you actually do right now?
Move 1, your immediate budget. This week, go look at how much you're spending on gas and think hard about whether there are any changes you can make to reduce that exposure. Combine errands, consider remote work days if available, carpool. Each dollar you're not spending at the pump stays in your pocket. The people who got hurt worst in 1973 and 1979 were the ones who hadn't planned for any flexibility in their transportation spending.
Move 2. Think about the second-order effects. Gas prices are just the start. Flight prices are already rising. Jet fuel is up 85% since the war started. Grocery prices will follow in the coming weeks as trucking and agricultural costs flow through. If you have a summer vacation planned, book flights now before airline pricing catches up to the fuel reality. If you're doing a big grocery shop, consider stocking up on non-perishables at today's prices before the supply chain inflation hits shelves.
Move 3. For investors. Look at your energy exposure. In every single previous oil shock, energy stocks significantly outperformed the broader market during the spike. In 2008, even as the S&P 500 was collapsing, oil companies were posting record profits. If you have zero energy exposure in your all-weather portfolio from episode 7, this is your reminder that energy stocks and energy ETFs act as a natural hedge when oil spikes. Tickers like XLE or VDE give you broad energy sector exposure. Not speculation, a hedge against exactly the scenario we're living through right now.
And move 3.5. Don't panic sell your broader portfolio. The historical record is clear. Yes, oil shocks precede recessions, but markets also recover every single time. The investors who held through the 1973 crash, the 1979 crash, the 1990 shock, the 2008 collapse, they were rewarded. The investors who panic sold at the bottom of each of those events locked in their losses permanently.
History rhymes, and history rewards patience.
Grant, close us out. One sentence.
Every time in history that oil has spiked this fast and this far, the economy felt it deeply. But every time, it eventually recovered. The question was never whether America would get through it. The question was always whether you personally were positioned to participate in the recovery when it came.
Gas at $3.84 feels painful today, and it might get worse before it gets better. But Trek for Wealth is here to make sure you understand what's happening and what to do about it.
That's all we can ever do.
That's Trek for Wealth. This is one to share, especially with anyone who's been feeling that pump shock this week and doesn't understand why. Now they will.
All our sources are in the show notes. The EIA forecast, the AAA data, the Federal Reserve history, it's all there.
We'll see you next week. Keep trekking.
Take care, everyone.